There are obviously mounting concerns about the global growth picture. Are you seeing any red flags from where you stand?
So where we are today is, let me step back. There are two key drivers for the mining industry. One is GDP growth and the other one is trade. So we are watching the GDP situation in a very close manner, as you can imagine. The key one for us is really about China. And if I look at all the metrics today, and remember, I've got $25 billion of turnover with China every year. So we're selling iron ore, we're selling copper, we're selling bauxite, even selling diamonds, and we're buying around $1.3 billion of goods and services from China. So we have a pretty good understanding of Chinese situation. Is China slowing down today? The answer is yes, but is China as expected? We don't have any surprise whatsoever. And then, as you know, that the Chinese government is introducing more and more stimulus package that will have an impact at some point in time during the year. So today, are we concerned by the slowdown? The answer is no.
The answer is no. And in terms of demand from China, do you expect it to be in line with 2018, higher, less? What are you seeing from the demand growth?
So as we're having this conversation, if I look at my order books in terms of iron ore, high quality iron ore, or copper, or bauxite, there are no concerns whatsoever. Now, you know what? I do not control the environment per se. I can only control a few elements. So what is important from a Rio standpoint is to make sure we have the right quality of products, that we have the right relationship with our customer, making sure our costs are controlled, so we can make sure that we generate a lot of cash, as we did last year, and then we will continue to allocate the cash with discipline in order to deliver on our commitment, which is superior value for shareholders in the short, medium, and long term. And last year was a very good example of it, with $13.5 billion of cash returned to our shareholders, the highest in the 147 years history of this company.
Is it your view that the stimulus measures that China is enacting, particularly around infrastructure, is going to benefit companies like yours?
Absolutely. Any infrastructure investment in China means additional steel, means additional quality ore, means additional copper, means additional aluminum, and therefore bauxite. So absolutely, we will benefit from it.
We're obviously seeing the Fed take a much more dovish tone than the markets had expected. We're going to see probably a weaker dollar. This is beneficial for the mining sector, isn't it? Is it going to be enough to insulate you from some of the global growth headwinds, do you think?
As I just said, in our forecasting models, we had assumed that major economies will slow down, including China, but China is slowing down as expected, and therefore we are well positioned and well prepared to deal with the situation. So let's step back. What is the Rio Tinto equity story? It's about the quality of our assets, world-class assets, like our Pilbara asset in Australia, Western Australia, like our smelters in Canada. It's about the quality of our people, the quality of our technology, the quality of our balance sheets. Remember, we did finish the year with no net debt whatsoever. We did finish with $300 million of free cash flow. So whatever the market conditions are, we will continue to generate superior cash that we will allocate with discipline and in order to deliver superior return for shareholders.
But I mean, more accommodative monetary policy is beneficial.
Very good. More infrastructure, more iron ore, more copper, more bauxite. Very good.
In terms of the trade war, there was a sense that we were getting close to a deal, and now we're hearing from the US that tariffs aren't going to be lifted on Chinese exports to the US at the end of the deal. That's what we've heard from President Trump. Does that raise your concerns? You've said you're the optimist in the room.
And I remain the optimist in the room, and I believe, if we step back, in the last 50 years, a lot of wealth has been created globally. One of the key drivers was trade, all right? So I believe people understand that. Now, it's fair to say I hear the same thing in Canada, in the US, in China, in Australia, that sometimes people don't see the trade as being fair. So it's important that everybody sits around the table, put their issues on the table, and I'm absolutely convinced that common sense will prevail at the end. As you said, I'm the optimist in the room, and the sooner the smoke, the right quality of smoke comes out of Washington, D.C. or Beijing, the sooner, the better for everyone.
In terms of iron ore capacity, do you have that capacity to meet, in the medium term, some of the shortfalls that we're seeing in the market and profit from the higher prices?
So you're referring to Valley and the potential impact. So our view on the Valley is we need to look at into two time frames, the short term and the medium term. On the short term it's important to remember two things. One is Valley impact today is on low grade, and therefore the market has the ability to respond. All right. So in the short term, I'm not going to move in a big way, and we shouldn't forget. $10 of iron ore price is worth $2 billion of free cash flow after tax for Rio Tinto. So you can understand I would be very cautious and very conservative, as always, at Rio Tinto in relation to my response in the short term. Now, in the medium term, depending on what the regulator in China does, in Brazil, does in relation to Valley, then it could have an impact not only on the low grade but the high grade. At that point in time, we will look at different options. But at this point in time, no material response from the market should be expected from Rio Tinto.
Okay. Our own in-house analysts have said that the higher prices for iron ore could add around $6 billion in terms of cash flows for Rio Tinto. So I guess the question is, how do you deploy that additional cash? Is it in acquisitions, is it in capex, or rewarding shareholders again?
I cannot possibly comment on your number, but let me put it this way. We are very clear, our strategy is very simple. We generate a lot of cash and we allocate the cash with discipline, all right? The cash will be allocated in relation to the debt, and currently we don't have any debt. About the capex, and we have already provided a clear forecast for the next 3 years in relation to capex, 6.5, and then all the spare cash will be returned to the shareholders. So, and then in relation to the M&A, you know the answer. We'll keep a watching brief. If it makes sense, we will look at it. But to be honest, we have a very high threshold. And remember what I said in the past, 80% of the M&A destroy values. So we will be very cautious on the M&A front.